Hello and welcome everyone to the Center's Education Room. My name is Lauren Adams and I'm a partner and certified financial planner here at the Center. I'm here to tell you about 3 tax-savvy charitable giving strategies that can make your charitable dollars stretch further for the causes you care about while also potentially lowering your tax burden. Let's start with our base case. Most people who give charitably usually write a check or put that donation on their charge card towards the causes they care about. Well, I'm here to tell you there may be a better way. First, the QCD strategy, Qualified Charitable Distribution. Now, this strategy is for clients with assets in an IRA account and who are over age 70 and a half. Instead of taking a distribution from your IRA and paying taxes on that amount, you send them and then sending the money to your checking account to write the check. The QCD strategy allows you to send money directly from your IRA to the charity of your choice. Giving directly from your IRA to the charity results in those tax dollars not being included in your taxable income for the year. That usually results in a lower tax bill for you and can also have positive downstream effects like lowering the amount you may pay on your Medicare premiums and the portion of Social Security that is taxable to you, depending on your situation and your income levels, of course. For those age 72 and older, QCDs also count towards the distributions you need to take each year for your RMD as well. Now there's some caveats here. As I mentioned earlier, you need to be at least 70 and a half. Also, the charity needs to be a 501c3. And there are limits on how much you can give each year via a QCD, but that number is actually quite high at $100,000 per person per year right now. So there's strategy number 1. Now, instead of dealing with IRA assets, strategy number 2 deals with taxable assets, like the ones in your brokerage account. Once again, instead of donating cash, donating appreciated securities like stocks, ETFs, or mutual funds could be the better way. If you've been investing for a while, chances are you have shares that have gone up a lot in value. Normally, whenever you sell those shares, you'll pay taxes on the capital gains associated with that growth. Giving appreciated securities to charity allows you to deduct the fair market value of those shares without paying the capital gains taxes. You can even decide to buy those shares right back after you donate, which raises the cost basis of your holdings and ultimately will help you lower your tax bill in the future if and when you decide to sell. In addition to being a tax-advantaged way to give to charity, this can also help if you have a large concentrated stock position to trim that concentration risk without triggering a large tax bill. Again, caveats here, you need to make sure that you've held the security for more than a year, and there are IRS limits for how much you can deduct in a given year of appreciated securities. So you want to keep that in mind. Okay, are you still with me? Now that brings me to strategy number 3, gifting to a donor-advised fund. First, a history lesson. The 2017 Tax Cuts and Jobs Act significantly raised a standard deduction that many now enjoy on their tax return. This means that you have to give a lot more than you did in the past to push you above the standard deduction amount and actually let you see a reduction in your tax bill for the charitable dollars you give. That's why we often recommend that clients lump several years of charitable giving to help push them over that standard deduction amount in 1 year. And bonus points if that is an especially high income year for the client, like the year of a business sale or the years prior to retirement. A donor advised fund is like a charitable investment account where you can donate, get the tax benefit now, and then gift to the charities you care about later over time. And guess what? Strategies 2 and 3 can be combined, meaning you can decide to gift appreciated securities to a donor advised fund, allowing you to avoid capital gains taxes and lump your gifts together to try to maximize the overall deductions you're able to recognize over time. As always, we recommend you work with your tax preparer to understand how these strategies affect your individual situation. If you want to explore these strategies and more, contact your Center Financial Planner today. We hope this has helped give you some ideas for how to get the most bang for your charitable buck.